What I am about to tell you might be the most important piece of knowledge you will ever get. So pay close attention and stay till the end of the video if you really care about your future as a trader. Most people come to trading thinking the battle is out there. In the charts, in the news, in the economic data, and the candlestick patterns. They think if they just find the right indicator, the right system, the right signal, then they will finally win. But here is the truth that almost no one tells you at the beginning. The market is not your enemy. The market does not know you exist. It has no opinion about you. It doesn't want you to lose. It doesn't want you to win. It is completely, utterly, indifferently neutral. The real battle is not between you and the market. The real battle is between you and yourself. Between the calm, disciplined version of you that wrote the trading plan and the reactive, emotional version of you that forgets the plan the moment real money is on the line. Every rule you've ever heard about trading, every system, every principle, every guideline, it all eventually comes down to this one question. Can you manage what's happening inside you? That is the question that separates the professional from the amateur. Not knowledge, not intelligence, not a better broker or a faster internet connection. Mindset, psychological discipline, the ability to act from a place of clarity rather than fear. So let's talk about the 10 rules that truly separate those two worlds. And let's go deep, not surface level, deep. Rule 1, protect your capital. Before you ever think about making money in the markets, you must think about protecting what you already have. This sounds obvious. Everyone nods when they hear it, but very few traders actually live by it. Here's why. Most people enter trading with a secret belief. The belief that they are going to win, that they are smart enough, prepared enough, different enough from the people who failed before them. This belief feels like confidence. It is not confidence. It is a lack of respect for what the market can do. The professional trader does not think about how much they can make. The professional trader thinks about how much they can afford to lose on this specific trade without it affecting their psychology. That word matters. Psychology. Because a loss that is too large does not just take money. It takes your mental clarity. It makes you want to get it back. It activates something primal in the brain that starts making decisions for you. And those decisions are almost never good. When you risk too much on a single trade, you are no longer trading. You are gambling with your emotional stability. The professional defines acceptable risk before the trade begins. Not after. Not during. Before. They say, if this trade goes to this level, I am wrong, and I accept that. And the amount they risk is small enough that being wrong does not shake their foundation. Protecting capital is not just a financial principle. It is a psychological one. Because the trader who protects capital stays in the game. And the trader who stays in the game long enough, with the right mindset, has the chance to learn, adapt, and eventually win. The one who blows up never gets that chance. Rule 2, plan the trade. Then trade the plan. Here is something quietly devastating about how most people trade. They spend hours analyzing before the trade. Charts, fundamentals, news, pattern recognition. They do everything right. They find a setup they believe in. They plan their entry, their target, their stop. And then the moment the market moves against them even slightly, the plan dissolves. Why? Because the plan was made by the thinking mind, the calm, analytical, rational mind. But once the trade is open, the emotional mind takes over. The emotional mind is not interested in your plan. It is interested in pain avoidance and immediate relief. And when a trade is in the red, both of those instincts point in the same direction. Do something. Anything. Just make the discomfort stop. Moving the stop. Closing early. Adding more to a loser. Opening a revenge trade. These are not decisions. These are emotional reactions wearing the costume of decisions. The professional understands this. So they do something that sounds simple but requires enormous inner discipline. They make all the important decisions before the trade is open. When they are calm. When they are not attached. When they can think clearly. And then they execute that plan as if they were following instructions left by a wiser version of themselves. Because they were. The plan is not a suggestion. The plan is the trade itself. Deviation from the plan is not adaptability. It is emotional hijacking. Rule 3. Keep losses small. Every professional trader loses. That is not a motivational preamble. That is a statistical reality. In any market, with any strategy, some trades will not work. That is the nature of probability. And accepting this at the deepest level, not intellectually, but emotionally, is one of the most transformative things a trader can ever do. The amateur hears this and says, yes, of course, losses happen. But then when the loss arrives, they behave as though it should not have happened, as though the market made a mistake, as though if they wait a little longer, reality will correct itself back in their favor. This is where losses grow from small to catastrophic. The professional does not fight the loss. They take it quickly and without drama, because they understand something that changes everything. A small loss is not a failure. A small loss is the cost of doing business. Think about any business in the world. There are operating costs, expenses, days when revenue is low. No business owner in the world expects every single day to be profitable. They manage their costs. They keep expenses under control. And over time, if the business model works, the profits exceed the losses. Trading is the same. Each loss is an operating expense. The question is never whether you will have losses. The question is whether your losses are small enough that your wins can overcome them. Keeping losses small is not about ego. It is about math, about survival, about staying in the game long enough for your edge to play out over time. When you let a loss grow because of hope or denial, you are not being optimistic. You are borrowing emotional debt from your future self, and that debt always comes due. Rule 4. Control your emotions. Let's speak honestly about something uncomfortable. You cannot fully eliminate emotions from trading, and you should not try to. Emotions are information. Fear tells you something might be wrong. Excitement tells you an opportunity might be nearby. Doubt is sometimes your intuition speaking in a quiet voice. The goal is not to become a robot. The goal is to become aware. Self-awareness is the foundational skill. Before you can manage your emotions, you have to notice them. You have to catch them early, before they make the decision for you. Most traders only notice their emotions after the damage is done, after they move the stop, after they added to a loser, after they traded without a setup and lost. Then they feel regret. And from regret, they promise themselves, next time I will be different. But nothing changes because they never caught the emotion in the moment. They never built the habit of pausing, noticing, and choosing. The professional builds a different habit. Before every trade, and during every trade, they check in with their internal state. Am I anxious? Am I overconfident? Am I trading to get back what I lost this morning? These questions sound soft. They are not. They are among the most practically powerful questions a trader can learn to ask themselves. Because a trade entered from a place of fear or revenge is already compromised. The setup might be perfect. The analysis might be correct. But if your emotional state is distorted, your execution will be distorted too. Emotional control is not suppression. It is clarity. It is the ability to feel what you feel without letting it pilot the trade. Rule 5. Never add to a losing position. This one is worth saying twice. Never add to a losing position. Because in theory, it sounds logical. The price has moved against you, so now it is cheaper. You can average down, reduce your average entry, and when it comes back, you make even more. The logic is clean. The psychology is toxic. Here is what is actually happening when a trader adds to a losing position. The trade is telling them something. The market is communicating. It is saying, the thesis you had at the time of entry is not being confirmed right now. Adding to that position is not a trading decision. It is a refusal to listen. It is the ego saying, I am right and the market is wrong. I will prove it. And occasionally, they will be right. The market will reverse. They will feel brilliant. And that one experience will reinforce the behavior forever. But over time, over many trades, over months and years, this habit destroys accounts. Because eventually a position goes so far against them that no amount of averaging can save it. And the larger the position grows, the more psychological pressure builds. Until the only way to stop the pain is to close everything at a devastating loss. The professional has a different relationship with being wrong. They have learned to accept that any trade can be a losing trade. They do not need to be right about every trade. They need their system to be right over time. And a losing trade is simply information, not a challenge to their identity, not a mistake to correct at any cost, just information. When the trade does not behave as expected, that is the signal to reduce the position, not increase it. Rule 6. Follow the trend. There is an old principle embedded in every style of trading across every market in history, and it is this. The market in motion tends to stay in motion. Now, This is not a guarantee. Nothing in the market is a guarantee. But over thousands and thousands of trades across decades of data, the probability of continuation tends to be higher than the probability of reversal. So why do so many traders fight the trend? Because the trend does not feel comfortable. When the market is going up, the amateur looks at the chart and thinks, it has already gone up so much. Surely it must come down. They short into strength. They get crushed. When the market is falling, the same trader looks at a chart and thinks, it has already fallen so far. This must be the bottom. They buy. It falls further. This is contrarian thinking dressed up as sophistication. But more often it is just the human mind trying to predict reversals, trying to be the one who caught the turning point, trying to be clever. The professional does not need to be clever. The professional needs to be consistent. Following the trend is not exciting. It does not make for impressive stories, but it aligns your trades with probability. It puts you on the same side as the market's current energy rather than fighting against it. And fighting the market is perhaps the most exhausting and expensive thing a trader can do. Rule 7. Keep a trading journal. Most traders who hear this think, yes, I should do that. Almost none of them do it consistently. And that gap between knowing something is valuable and actually doing it is itself one of the most revealing things about trading psychology. A trading journal is not an accounting spreadsheet. It is not just entries and exits and profit and loss. A real trading journal is a record of your mental state, of your reasoning, of your feelings before, during, and after each trade. Why did I take this trade? What was I feeling when I entered? Did I follow my plan? If I deviated, why? What would I do differently? These questions force something that is extremely uncomfortable for most people. Self-honesty. The patterns in a trading journal are not always about strategy. They are about you, about the recurring emotional habits that sabotage your results. You might discover that you consistently exit winning trades too early because of anxiety. You might discover that you widen your stop when a trade goes against you, but never when it goes in your favor. You might discover that your worst trades all happen in the first hour of the session, when you are reactive rather than focused. None of that is visible without the journal. The mind is very good at editing its own memories, at remembering the wins more clearly than the losses, at constructing narratives that protect the ego. The journal cuts through all of that. It shows you who you actually are as a trader, not who you think you are. And knowing who you actually are is the beginning of being able to change. Rule 8. Be consistent, not perfect. Perfection is perhaps the most destructive concept a trader can carry into the markets. Because the market does not offer perfection. It never has. It never will. The trader who requires perfect trades in order to feel confident will spend most of their time in paralysis, hesitation, or self-punishment. The professional has a very different standard. They do not ask, was that the perfect trade? They ask, did I follow my process? This is a profound shift, because the process is something you can control. The outcome of any individual trade is not something you can fully control. In any sequence of trades, even an excellent system with a strong edge will produce losing streaks. That is statistics. That is the nature of probability distributions. It is not a sign that the strategy is broken. It is simply the reality of outcomes in a probabilistic environment. The amateur needs to win the trade to feel like a good trader. The professional needs to execute the process to feel like a good trader. One of these people will have emotional stability across hundreds of trades. The other will be a hostage to randomness, euphoric on winning days, devastated on losing days, their confidence rising and falling with every tick. Consistency is not about being right every time. Consistency is about doing the same disciplined thing every single time, regardless of the last trade's outcome. That is the only consistency that compounds into lasting results. Rule 9. Stop predicting. Start reacting. Here is where many traders waste an enormous amount of energy. Predicting. Not just predicting what the market will do next, but being emotionally invested in that prediction. There is a version of market analysis that is useful, where you study the conditions, identify the probabilities, and make a plan based on what seems most likely. And then there is another version, where you decide what the market is going to do. You become attached to that outcome. And when the market does something different, you feel personally offended. This second version creates bad decisions, because now you are not reading the market. You are arguing with it. The professional analyst says, here is what I think is most probable based on what I see. Here is what I will do if that happens. Here is what I will do if it does not. They plan for both. They are not right or wrong based on what the market does. They are only right or wrong based on whether they executed their plan correctly. This is a form of psychological freedom that most traders never experience. Because most traders have unconsciously tied their self-worth to the outcome of their trades. If the trade wins, they feel smart. If it loses, they feel stupid. And that loop is exhausting and corrosive. The market is not a reflection of your intelligence. The market is not a feedback mechanism for your worth as a human being. It is just price, moving through time, reacting to millions of participants and forces that no single person can fully track. When you stop needing to predict and instead practice reacting to what actually appears on the chart in real time, with a plan already in place, the entire emotional experience of trading shifts. From anxious to calm, from tense to grounded, from reactive to present. Rule 10, patience is everything. Let's talk about the waiting. Because so much of trading, the part no one glamorizes, is simply waiting. Waiting for the right setup. Waiting for the correct conditions. Waiting for the trade to develop as planned. And most traders are terrible at this. They sit at their screens and they feel the pull to do something. To act. To be in the market. Because activity feels productive. Sitting and watching feels passive. Feels like laziness. But this is one of the most dangerous feelings in trading. A trade taken out of boredom is a trade taken without an edge. And a trade without an edge is not trading. It is gambling with extra steps. The professional understands that not trading is sometimes the highest quality decision of the day. That preserving capital and energy for the right opportunity is itself a form of discipline. There is also another kind of impatience. The impatience inside a trade that has not yet reached its target. The trade is going in the right direction. It has not yet reached the planned exit, but it is taking time. It is moving slowly, or sideways, or pulling back slightly before continuing. And in that waiting, anxiety grows. The trader starts thinking, should I just close it now? Take what I have. What if it reverses? And so they exit early. They leave most of the profit on the table. And then they watch in real time as the trade continues exactly as planned, without them. Patience is the skill that allows a strategy to fully express itself. Without patience, every edge is partially wasted. The market does not move on your timeline. It has its own timing. The trader who learns to accept that, who can sit with uncertainty without forcing resolution, that trader is already ahead of most people in this business. Let's take a step back from the rules for a moment. Because underneath all 10 of them, there is a single truth. One that Markdouglas spent his entire life trying to communicate. The market does not cause your emotional pain. Your expectations do. When you expect a specific outcome from a trade, when you need it to win, when your mood depends on it, when your identity is tied to it, you have already lost your edge. Not because the trade cannot win, but because you are no longer thinking clearly. The market is neutral. It moves. Some of those moves align with your trade. Some do not. Neither of those outcomes says anything about you as a person. But the mind that has not done the work, the mind that is still operating on fear and desire and ego, that mind cannot hold that truth when the trade is live and money is at stake. This is why so many intelligent people fail at trading. Not because they cannot analyze a chart, but because they cannot manage what the chart does to them emotionally. And this is why the path to becoming a good trader is ultimately the path